This is Robert Kraft, and I'm your host on the Planet MicroCap Podcast. And with me today, my guest is Scott Miller. He is the founder of Greenhaven Road Capital. Scott, thank you for joining me today. How you doing?
Yeah, I'm happy to be here. Looking forward to this. It's my first podcast, so let's see what we got.
Well, I'm really happy to be the one to break you in, and I promise to go easy on you.
All right, thank you.
All right. So to really get started here, I doing a little bit of research about you and Greenhaven Road Capital. I saw according to your bio that you actually really got your start investing after graduating from Stanford Business School in 2000. Not to date you or anything. And I mean, did you always have an interest in investing?
Yeah, it's a good question. Look, I grew up in New York City, so a little bit around finance, probably more than someone who kind of grew up in Akron, Ohio, or something. One of my best friends growing up, his dad was one of the early hedge fund investors and was actually featured in a book called Market Wizards. And so I read that book. To really date me, that book came out in 1989. So it's a classic at this point. But like in the book, they feature I think it was like 15 fund managers, and it was eye-opening to me, the number of ways that people made money, and it just sort of seemed really interesting. And my father ran a white shoe polish company, which was wonderful in many ways. Like, it put me through college, right? But when I read Market Wizards, that seemed more interesting than the shoe polish business. And so back then there weren't that many ways to sort of enter into investing. There was less personal investing. They didn't have podcasts and Twitter and blogs. And by the way, people make fun of Twitter, but I find it to be a really good resource. All this classic investing content is out there if you find the right people. And so, but that didn't exist for me, right? And so, I watched a lot of CNBC. Jim Cramer from way back, and the signal to noise ratio wasn't great, but it's what I had. And so I had an interest in investing. When I graduated from college, I didn't do 2 years at Goldman Sachs. I worked in a family business, not the shoe polish business. My dad was also involved in a paper bag business. So I spent 4 years in Yonkers, New York, managing a bag factory and learning business. I think people operating a business is a really good foundation for investing, right? I think it helps you understand the companies that you're analyzing. And so, I saw a really bad business, like front row, right? So paper bags, like cyclical, low margin, effectively no barriers to entry, right? And so that was my world for 4 years. And also, look, we did a lot of direct mail at that point, and it was all about like what were customer acquisition costs and lifetime value, which is sort of novel analysis in the SaaS world these days. But like we were doing that back in the day, and so I had a lot of interest. Had more of an operating background, went to business school, and then went to work in a private equity type setting. And at business school, I did kind of an investing track. This guy, Jack McDonald, who was, the sort of legend there. I did hit all his classes, and then I went and worked at a fund where we had, private equity is very long-term time horizons, and looked at product markets and teams. And then, eventually ended up going to work at a fund. So I think I had the seed was planted in high school. It took a long time kind of between high school and when Greenhaven Road was founded, and there was kind of a combination of operating businesses and investing along the way.
And Scott, what would you say then led to the development of Greenhaven Road Capital?
Yeah, I think it's kind of a long journey. I had a lot of success investing my own money, my personal savings, kind of after business school, and applying what I'd learned there and in the private equity setting and public markets. And, quite frankly, I owned Apple for an entire period where you really wanted to do it. Bought it from kind of cash on the balance sheet to, the iPod and eventually the iPhone, getting multiple on it. So, that helped. And so it's a combination of had an interest, had a fair amount of success. And then, I just find it interesting, right? Like, some people like to fish. I love to invest, right? To me, it's not really work. It's fun. It's putting the puzzle together. It's like trying to sort of predict what's going to happen and how it'll be reflected in the share price. And so, I ended up where I was in this operating role. I was a CFO of a business, but I really wanted to invest full time. And so it's like if I was walking my dog, I was thinking about the portfolio. I wasn't thinking like, how do we make our customers happy? And so I knew I had to make a change. And that's not so easy going from the CFO of a business that manages Head Start centers to a professional investing role. Even I had a pretty good resume, but nobody was like, that's the analyst we want. But I was able to, some folks who had been through the investing program at Stanford had started a fund. I was able to work there, and I was there during the financial crisis, and that's a whole kind of separate vein we can go down. But the sort of how did Greenhaven Road get started? Well, during the financial crisis, the fund that I was working at lost a lot of the assets, not really performance related actually, but liquidity related. And so I was out, out of the business again, and I was trying to get back in. I went back on the operating side, and but I was applying for jobs, and I basically went through a process where I pitched a company that I knew from the operating side. When you apply for jobs, right, there's often a stock pitch component to it, right? And I went to this fund. I pitched a company. I knew it from the operating side. It had this off balance sheet thing. It was really quirky. It was good, I think. And in the course of like the 6 weeks I was interviewing, my write up said like it would get acquired by General Atlantic Partners at a big, for about $2 or whatever. All this happened, right? I like hit a walk-off home run during the interview process, and I didn't get the job. And I was just like, oh my God. I was up like an absurd amount in my personal account. I just crushed the interview. I didn't get the job. And I was like, well, I can like have these people validate me or try and find someone who thinks I can do this, or like I can start my own, my own thing. And so, instead of waiting to get invited to somebody else's party, I was like, look, I'm just going to do it on my own. And so I was able to, I took $1 million in personal savings. And I raised $1 million from friends and family, based on, kind of the track record that I'd put up. And so, now, just to be clear, that's like, it's not really a great business, a $2 million fund, right? And so I ended up working for continuing my day job for the first, 4 years of the fund. So it's a whole another story about like how much time do you need to spend on running a fund, et cetera. But long story short, I had worked in a real fund setting. I felt like I had the ability to do it. Couldn't, other people didn't agree with me. I eventually started my own thing.
I mean, what a story. I mean, I can't believe you walk in, you hit a home run in the interview, you have a great pick and everything. I'm so curious what happened there. That's so strange.
Well, I think he actually hired his brother, which so on some level, like, hard to compete with that. And I actually saw the guy like a month ago at a conference, and I'm sure he doesn't remember me. I certainly remember him, and then he was with an analyst, so his brother, not his brother. So that's it.
Hey,
he's still in the game. He's still in the game.
Hey, nepotism is it's a powerful thing. I guess.
A thing.
So, I also want to mention on your website, you talk about you have your partners fund on there. So I'm also curious what led to the creation of that.
Yeah. So we have a fund of funds that's focused on small managers. And so I basically came to the conclusion that I had a number of LPs that, look, the world is not set up to invest in small managers. People don't actually, there's career risk involved in it. There are some risks that small funds come with small funds, right? So, and then a fund of funds focused on really small funds is not a great business. Because you charge very low fees, and if you're going to charge very low fees, you need huge AUM. And so as a consequence, if you have huge AUM, then you're not investing in really small managers. So it's like this, it just kind of doesn't make sense as a standalone entity. But, I think historically superior returns have been generated by small managers. I felt like I had a really good network of small managers. I had a group of limited partners that wanted something that was Greenhaven Road-like, and maybe they had their full Greenhaven Road allocation, but they would, be interested in this fund of funds, assuming the kind of fees were fair, et cetera. And so, basically our criteria for the partners fund are investment committee of one, concentrated holdings, reasonable AUM, original thinking, significant personal investment, and a mindset where getting rich is not the point. Like, obviously we want people that want to make money, but I think kind of like me where, the way I think about it is if you have someone who's thinking all day about the Ferrari they want to buy, right? Oh, I want the whatever trim and this and that, or the guy who's thinking all day about, what's the product cadence? When are they going to put out the SUV? What are the margins going to be on that, right? And they're putting together the business puzzle. I way rather have the guy putting together the puzzle than the guy who's like thinking about how they're going to spend the money. And so that's the idea behind the Partners Fund, and we're investing in about a dozen small managers. And I think back to kind of it doesn't really make sense as a standalone business. For me, it's part of like putting together an ecosystem, and so it has been a source of good ideas for me. And so if I put one good idea through our kind of main fund, the economics are really good. And so, while it's not a good standalone thing and no one's probably going to go recreate it for a variety of reasons, I think given kind of what I'm trying to create here, it makes a lot of sense on a standalone basis and as part of Greenhaven Road Capital.
Mm-hmm. So I actually, before I get to your investing philosophy, which we're going to get into very shortly, I actually do want to go back to, that jump from when you were still working the full-time job for 4 years and running the fund, because a lot of my audience happen to be smaller fund managers, have,
right.
Only a few million AUM or maybe 15 to 20 or less, whatever it is, so I'm just curious, at what point during that 4 years there, you were like, okay, once I hit this threshold, then I think I'm ready to go off on my own.
Yeah. So, I'd say a couple of things. One is my investing style was conducive to doing it kind of on the side, right? So I'm concentrated and I'm low turnover, right? So I'm not like trying to trade news flow, and I'm basically investing in things I generally understand, right? And so, so it was conducive to it. I also kind of was able to peel back my full-time gig to kind of 4 and 3 days a week, and so I had a pretty nice kind of balance there. I think at the end, though, there were a couple things that tipped it for me. One was, quite frankly, like hair started falling out in places that it shouldn't have fallen out of. Like there was a stress component that was going on in the operating world. Like operating business is so much harder, in my opinion, than investing. Right? Like it just you're not in control. It's just much harder. And so there was a kind of a stress component to it, but also I had a year where I had really good returns, and I added one limited partner, right? And so I wasn't doing any marketing. And so I went to my wife and I was like, look, there are a couple things going on here. Like I have a track record, I think that appeals to people. I'm basically in the closet because I haven't been totally forthright with the people I'm working with that I'm doing this also, right? I didn't, if they asked, I would tell them, but like I didn't like advertise
right
that I was doing this, right? And so and look, I'm managing our life savings kind of, on the side. Like that doesn't totally make sense. And so, and also, quite frankly, my wife worked. And so like we had income, we had a bunch of savings, had a track record. I'm like, if I don't take a run at this, like so I totally de-risked it. Right. And so then I kind of went for it.
And then your previous employers all became the next LPs. No, I'm just
yeah.
Oh, they did. They did. Oh, good.
I've been really fortunate, right? So at the fund I worked at, that we ran into some trouble. Those guys were, 3 of the folks from there are limited partners. The CEO I worked with in the operating business is a limited partner, and my first boss is my dad, and he's a limited partner too. So yes, so they over time became limited partners. Yes.
Nice. All right, so to dig now into the firm's and funds investing philosophy, as it states on the firm's website, and I quote, we carefully cultivate the unusual to create a lasting, uncommon portfolio, end quote. So I'd love for you to elaborate a little bit more on the firm's investing philosophy.
Yeah. So, I think on some level, my philosophy is like, do what works, right? And so I think of this as a 30 or 40 year vehicle. Times are going to change, and I have to kind of adapt, right? And so I don't have like a specific like formula for anything, but I do think I have some advantages, right? And so I do want to take advantage of those. So I can be selective, right? Like, I have a very broad mandate for my investors. I can be as selective as I want to be. I can go anywhere geographically. I can go anywhere market cap wise. I have a really long time horizon. And so, I think we use some words like unusual, uncommon, right? Like, I'm not looking to just like recreate an index fund here. That's not like going to be my life's work, right? And so I want things that are, I believe to be highly asymmetric, right? And so, and that's going to change over time. And my definition of value is going to change over time. But, I think we're going to put together, I don't want to like overstate it, but like I think more of like a craftsman, like trying to kind of put together something thoughtfully, right? And so we're going to both put together different companies that are perhaps misunderstood. These aren't things that are necessarily going to screen well, and we're going to, as I put it together, we're trying to take different sets of risks, right? And so it's not just going to be all one version of like long commodities or something like that, right? I mean, some of them are going to be around like the team. They're going to be more jockey bets. Some of them are going to be more industry bets. Some of them, they're going to have different embedded risks in them if we do it right.
For sure. Well, what I thought, because I mean, as you're talking to kind of a microcap guy here, micro nano cap guy. So when I saw unusual and uncommon, I was like, that those are very familiar words in our atmosphere, to say the least.
Yeah.
I mean, I'm sure it sounds like when you're in that.
Look, I mean, so half my portfolio, or more is kind of sub $1 billion. And I think just one other thing in terms of like what I'm trying to do, I am trying to create an ecosystem and give myself certain advantages, and so that's like kind of less about a firm philosophy, or maybe that is the firm philosophy that I'm trying to give myself advantages. And so, the Partners Fund we talked about. I think the other piece is I have Chuck Royce, who in the microcap world is one of the godfathers or pioneers of microcap investing, and I work out of his family office. He's he's my seed investor, and so I basically I was able to partner with him, and I get access to a bunch of resources and IP that I wouldn't have otherwise. And so and then I think the kind of third piece, if I'm putting this together right and have some advantages, it's the Partners Fund, Royce, and then my limited partner base is my biggest group of investors are themselves investors. Right. So maybe I'm a chef's chef, or, however you want to view it. It's people that have run funds, used to run funds, work at funds, and then we have a bunch of entrepreneurs. And so I think I'm really lucky to have the LP base that I do. And, I think just as an aside, or you said sort of a bunch of people are out there kind of building their funds. I think I have two things. One is like, I actually don't like to make the ask. So I had people I've known for a long time, right? When I had almost no assets, I wasn't going to them and saying, "Hey, like I have this fund, please invest." Like, but so I don't make the ask generally or ever. But so we've had people come in, right? So the letters go out, people hear about it, something resonates with them. Quite frankly, we don't follow up either, and not in a bad way. Like if people have a question, we'll answer it. But the general notion is that at the end of the day, people are going to be hopefully highly philosophically aligned that do choose to come in and really want to be there. And so, my style, right, is going to have volatility, and we're going to have down periods, right? We're going to have down, months, down quarters, down years. And, but I really want to have a long time horizon. So I need really philosophically aligned investors, right? Who understand that like, we're not going to have a smooth 8, but, we might have a bumpy 12, and that's going to actually be way, way better. Right. And so, I think in terms of like philosophy, right, like we're trying to get the right people in the fund, like, and just be transparent, like this is what we're doing. And, I think one other thing is like I put out these fairly long letters, and I walk through like key holdings. Right. And so I don't want to just be like this black box that spits out statements like, every 3 months. And like all they have to go on is like, hey, you were up a little bit, you were down a little bit, or whatever. Like, I want them to know what we own and why we own it, right? Because, like, and they may not agree with it. They may decide to redeem because of it, but like, they're also more likely to stick around because they understand how I think, and hopefully it's aligned with them. Or, sometimes I'll hear like, I like what you're doing. I can't do it myself, or I would do it if I had more time. And, those are the types of people we want.
Gotcha. All right. So you actually mentioned a little bit earlier, a little bit about your investing strategy and that you're concentrated, and you said something else as well, but of course it's not coming to me. But, why did you then choose this strategy to really reflect the firm's philosophy?
So, look, I think in terms of concentration, there are a few things. At the end of the day, right, like, I don't want to invest my 50th best idea, right? Like my 10th best idea, I think, is probably better than my 50th best, right? I actually, for a variety of reasons, believe there are a lot of ways to make money. I think for me personally, like investment committee of one is the right way to do it. I can't track 100 things well, right? And so I want to be concentrated enough that if I'm right, it matters, right? Like I'm rewarded for it, right? If I have 150 positions and I'm right, like, okay, great. But if I'm wrong, I don't blow up, right? So I'm not going to be a fund of like my life savings here. I can't be like, go back to my kids and be like, sorry guys, daddy was wrong on that one. Like it's time to move. But so it's like, it's the balance. And to me, it's roughly 15 positions. Sometimes we might get down to 12. Sometimes we might creep up to 18 or 19, depending on a variety of factors. But it's in that range of like, if we're right, we get, we're rewarded. And if we're wrong, we survive.
All right. So let's dig into that criteria then that you look for in a potential new investment to add to that portfolio. What are some of your criteria?
Yeah. So, I think at a high level, the portfolio is split into two groups. There's high quality companies that we'll hopefully own for 5+ years, and there's special situations, and the criteria are different for those. I think for both of them, I think we want some asymmetry where hopefully there's substantially more upside than downside. I think in both of them, generally not looking for something that is trading for $20, it might go to $22, right? We're probably taking slightly bigger swings in that, and so I think ideally, particularly on the companies we're going to hold for a longer period of time, high insider ownership is something I really focus on, probably more than most investors. Just believe in the alignment of incentives. It's also, to me, an indication of capital allocation skills, right? If somebody, I've been on the other side of raising money and everything. Like, if you're able to hold on to 40% of your company and through going public, like you've made a series of really good, capital allocation decisions there along the way, probably. So higher insider ownership, recurring revenue, and operating leverage, or there's like expanding margins. And so those are, we don't always get all three of them, but those are things we like. And then I run it through this lens that sort of predates to the private equity world of product risk, market risk, team risk, and execution risk. And those are sort of some quick filters I do on investments. And
so this is a question I've asked to a few guests I've had on here, and I'm curious to your opinion. What type of hair would you say, or things that you're like, this company has this, but I'm okay with it because it meets 2 out of the 3 or 4 out of the 5 things that I'm looking for a potential investment?
Yeah, I think that answer is coupled with what do I think the upside is, right? Like, and how am I sizing it, right? So we will, from time to time, invest in things that I think have a decent chance of being a zero, right? Which doesn't seem like a very good strategy. But if I also think it could be a triple, right? And I go, okay, there's a 15% chance it's a zero and an 85% chance it's a triple, the expected value is actually pretty high. So now, look, we're not going to make that a 15% position, but I take a series of those, right? And so, I think, look, if you can't trust the financials, that's like pretty hard to invest. I really believe that people build businesses, and when you get into, potential fraud and convicts, that's really hard to do. Although, I invested for a while in this company, Libsyn, which is LSYN. I don't know anymore, but And investor Eric Shahanian like got in there and fixed it, right? But it was super compelling for all these valuation reasons, and you had like problematic management. So like it's tough for me to say like I would never do this, because if in the right kind of situation, I just might. Again, look, it has to be really asymmetric. We have to be getting more than rewarded for the hair, and the best kind of hair, right, is that which can go away or be fixed relatively easily. And so,
Gotcha. So I'm probably gonna edit this part out, but it's so funny. I literally was just looking at this more because I use Podbean for posting the podcast. So I was just looking at, because I had that, I've been using that from the beginning. So I was actually just looking at that versus Libsyn, just out of curiosity.
There's like there's some crazy stuff that happened with Libsyn, and there was a guy in China who was in jail who owned 11% of the company. And like I was trying to like get his shares, right? Like that was one of the things. Like part of it is like you get rid of that convict, like that sort of helped, and if you could get enough shares, you could challenge management that was doing sort of all these funny things. And but I don't know.
Yeah. Well, so real quick, I actually wanted to follow up on something you talked about earlier when it came to Chuck Royce as your seed investor for the fund. I mean, that's such a validation. I mean, I actually had Bill Hench from Royce on the podcast back in some of the earlier episodes. So, I mean, what were some of the lessons that Chuck gave you some confidence moving forward with Greenhaven?
Yeah. So I think the biggest lesson, I think, look, there have been a ton in terms of how to live your life and how to treat people. And, I think he's an absolute gem. And like, there are people in the world, he's a special guy. Let's leave it at that. But I think from an investing standpoint, one time I went to him and I was looking at something that was, super illiquid, but pretty interesting. And I asked him about like the liquidity premium or illiquidity premium that, kind of he would demand to go into a situation like that. And he basically said, you're kind of not looking at it the right way, which, not that surprising. But he's like, you just have to be sure you're going to get to the other side, right? Like basically this type of situation when liquidity is super constrained, you're getting married, and it's about like, how confident are you that you'll get to the other side? Which, I think is particularly in like the, nano cap world, right? It's super relevant, right? Like, I quite frankly own some shit, a couple things that haven't traded today, right? Like, my ability to get out is limited. And so like on the front end, I had to be comfortable that I'd be there for 5 years or longer, and that there was no easy way out. And so, I think he's seen it, kind of a bunch of different ways. I think the other, little, not like kind of bumper sticker saying, but he generally like, there are exceptions to every rule, but he's like, we've been involved in some things that have, days where they've sold off, and his first reaction is actually to buy, but not to sell. Like it is not sell. And then it's like, should we be buying? Right. And so I think where most people are like literally running for the exits, he's like, all right, probably going to stand our ground here. Should we be buying? And I think on the fund to fund side, actually, he's very interested in managers who had a tough period, right? And so there's like this notion of reversion to the mean, and I think the tendency when looking at managers and poor managers is going with the hot hand, right? And he's done it enough times and seen enough people that he's at least asking the questions like, who's down the most? Doesn't mean he's actually putting capital in there, but like it's an interesting hunting ground. So who's had a really strong track record, who's had a tough run here, and so I think there's an enormous amount I've learned from him. I really enjoy spending time with him. I think there are also lessons just in terms of being a generous person. I mean, he just sort of is generous to people in ways where he's not doing it because he expects something back. It is, sort of pure generosity, which is cool. A pleasure to watch.
That's so cool and really awesome. I'm sure literally we could do a whole episode just on everything you've learned from him. So, we'll save that for next time. Uh, now I want to actually get to the Q4 2019 investment letter that you just put out.
Yep.
What were some of the key takeaways that you want our audience and readers to know and be aware of this last quarter and for 2020?
Yeah, I mean, let's see. I'm gonna think about that. I mean, the letter wasn't written for your audience, right? It was written for my investors. And so, I mean, I would say what I wanted them to know, which I think has some relevance to your audience, was, hey, a lot of this is what we don't own, right? And so, um, you know, I underperformed the S&P 500 in 2019, right? And so, I also don't own anything right now in the S&P 500. And so in the letter, I tried to kind of pick apart, is that a good thing or a bad thing, right? Like no one has a gun to my head and says I can't own Apple, right? But, what do you think happened to Apple's revenue and earnings? Apple was almost doubled last year, right? What do you think revenues and earnings did last year? That's a question. I'm turning this around.
Oh, you're turning this around.
Question for you.
I'm gonna assume it didn't double.
Stock doubled.
Not the revenues.
Right. Revenues and earnings were both down.
Yeah.
Right. Okay. And so that's the largest company in the S&P 500. Look, and I get it's partly forward and there's a product cycle and there's sort of reasons for it and stuff. But a lot of it was last year was effectively multiple expansion. Right. And I also looked at, Microsoft, and another question for you. What do you think Microsoft's EV to sales is? Like what multiple of sales is Microsoft trading at?
It beats me. I haven't seen.
It's a big company, right? It's in year 30 or whatever, right? Like it's not a startup anymore. Here, it's growing. Almost 9 times sales, and it's got a growth rate like 14%, right? So like, it's not going to double. In what time frame is it going to double? Like I don't really know, but my point was that, like, look, these things did well last year. And, God bless the people that own them. And they're good businesses. And we've owned them in the past. And maybe we'll own them in the future. But, like, it doesn't feel like the next bubble for those super large companies is going to be that easy. And so I wanted to make that point. And, like, we'll see if we get rewarded for being kind of more on the fringe or not and when. But I wanted to make that point. I think the other thing, I'm going to a couple names if you want. I mean, I went into our portfolio. In all our letters, I go to the top 5 holdings. I think one of the larger cap names I own is KKR, and people hear that and they're like, oh, KKR, it's the private equity behemoth, and they're like, well, it doesn't seem like a good time to be investing in private equity funds, right? And so like it's kind of late cycle, valuations are high. And so that's a pushback I get a lot when I talk about KKR. And my point that I made in the letter is that we're not taking like a decent chunk of our life savings and investing in KKR Fund 17. We're investing in the company that runs Fund 17, and that's a different economic choice. And effectively, our bet is that KKR is going to continue to raise money, and because they get paid a management fee and they get paid an incentive fee, and so while those incentive fees may be lower, those management fees are going up. And so if you're running a pension fund and you need a path to an 8% return, are you going to buy some negative yielding bonds? What are you going to do? By the way, you like the smoothness of the private equity returns versus the volatility of the public markets, because last year when you were down, 10 in your, Russell 2000 or whatever, that didn't help your story of getting +8 every year. And so like the point I was trying to make is that they're going to raise a lot of money for a variety of reasons, and they're also under earning. And so I went into KKR in a fair amount of depth.
Gotcha. All right. I mean, if did you want to go through a couple others that you mentioned? I mean, it's all out there for people to see.
It's all out there. I mean, people can go read them. I'm probably a better writer than the speaker. I think give you 2 other ones that I kind of talked about in the letter. One was a special situation. So one of the things I invest in occasionally are SPACs, so special purpose acquisition corporations.
Yep.
Someone on Twitter labeled them murder holes, right? So historical returns on SPACs are negative, and so it's a good time to walk away. ticker's Calera, is one where we kind of started buying the rights, which is a sort of quirky security that was part of the offering. And the point I wanted to make to my investors was we bought rights that would have value if the deal closed. And so the way a SPAC works is that they have a blank check, they come up with a deal, they propose it to shareholders. If the deal passes, it becomes a company and the rights have value. And so what initially started out as a sort of, I guess I'll use the term bet, that the deal would happen, worked out. And there were a variety of factors in there that made me confident that it had a really good chance to happen. And so while this is one of those ones that could have been a zero, right? But I thought the expected value was, of it was very high. And so we kind of sized it small, but enough to be meaningful. And so the deal happened. And then eventually we were able to make an agreement with the company where we would effectively get paid to hold our shares. They would buy our shares back at a set price above market over time, and we would get paid to look at effectively 3 earnings calls. And so the point I was trying to make to my investors was, one, I think we have asymmetry here. We've almost, I think, assuming that their credit good, we've taken out any downside. We've locked in a medium upside. And, based on the company's valuation and ever, I think we could, have the potential to do really well. And I also kind of want to make the point in there is, you don't own this in your portfolio anywhere else, right? Like, nobody else was out there buying, rights on the, Gig Capital One SPAC that turned into Calera, and et cetera. And so, I think it was a series, hopefully, of kind of intelligent risks that we took, and it manifests itself ultimately in a larger position through appreciation. And then I think the third one, the company that I talked about was a company, Par Technology, which is a restaurant point of sale system. And it effectively, for us, it's a jockey bet. It's around the CEO. A new CEO came in about a year ago. I think he's done, just about everything right. And from capital allocation, from raising capital to bringing in a better team to an acquisition. And so, I was trying to highlight some of the success and progress that he's made. And just as like a little aside, so we run an investment partnership, right? And I do view it as a partnership, and I want people to understand what we own and why we own it. And so every year, we bring people together for an annual meeting. We're not the only people that do this, but it's, to me, important. And part of that process was last year I brought in the CEO of Par Technology, who was nice enough to come and do a kind of talk with our investors. And so we're trying to kind of reinforce, remember, this is the guy you met. This is what he did since, and this is why we still believe. And so there's kind of we're trying to put together a whole package for people, and again, make them feel comfortable with what they own, know why they own it, et cetera.
Sounds good. It's funny. When it comes to Par Technology, listen, I don't follow Microsoft, but Par Technology, I remember them putting out a ton of news. I think it was 2 years ago. It was literally every contract went, and it seemed like it was every other week, and it was huge contracts. And I remember just seeing on a few forums, just what these huge contracts? What do they mean? Every single time, it's a new one every week. But anyways,
they're in the process of trying to deliver on some of the customers they have and build the business. And again, I think people build businesses, and we'll see. I think they have a pretty good CEO.
For sure. Okay, so this is a question I really have just started asking actually to a lot of my guests, and I think it's very apropos. Here is, what would you say has been the most difficult part of your job?
Yeah, I think I'm very lucky. I'm beyond lucky, and I really feel it every day. I think the hardest part, honestly, is delivering bad news to our investors, right? So look, I've tried to condition people that we're going to have down months, quarters, and years, right? But it's not fun to tell them that, right? And quite frankly, I have so far has been a very understanding limited partner base, and so I've been really lucky. But for example, in the first year, when I raised money from, only the closest people, right? Like I told you before, I don't like to make the ask. I was only, it was my parents, my roommate from college, it was the closest of the close, and we're down, right? And so that was not fun to tell them. And now looking back on it, they made the investment probably more just to help me, quite frankly, than they were expecting financial returns, right? Like that's just the relationship we had, and I was lucky. But that was, and we've had other, down quarters and stuff like that. We've had down years too, right? And so, but that's to me never fun to, sort of explain that.
Yeah, delivering bad news is never fun.
But it's gonna happen.
But yeah,
I mean, I signed up for it, and so
yeah,
we do it.
Yeah. It's fun. It's funny you say that. I know a lot of individual investors who, like you, were doing very well personally, and that was one of the reasons why they didn't want to start a fund. They're like, I don't want to deal with having investors, basically, because it's just it's hard. You're not just depending on yourself anymore, or you're not just feeding for yourself. Now you're you have this group of investors you have to answer to. So
I would say two things. I mean, one is I report quarterly, right? Mm-hmm. So I'm not trying to explain like the month-to-month moves. I report quarterly, which takes out some of the noise. And if you get the right investors, it can be a huge asset. Mm-hmm. It can be the right investors can be a huge advantage. And so I agree. Having the wrong investors it doesn't sound like a lot of fun, mm-hmm. right? But if you get the right folks, it can both be a source of ideas and a source of really valuable feedback that helps you prevent some larger mistakes. And so,
gotcha.
I wouldn't rule it out. Just having investors, I wouldn't just be like, no.
So then what investing experience would you say has impacted you the most in your career?
Yeah, I mean, I think I alluded before. I worked at a fund during the financial crisis. It was called Litmus Capital, and we had two, really smart portfolio managers. And I think I saw two things. One is the rules of the game changed in ways that I won't forget. Right, so there was one weekend we were short a bunch of regional bank stocks, and over one weekend, the SEC or the Congress declared you couldn't short these types of stocks. And so, like Monday morning, we went in and had to cover all these things. And like the rules of the game literally changed in the middle, and that was not pretty. And that just will remember that you think everything is set, whatever, but like this is pretty fluid, and it's all kind of the rules are the rules until they aren't. But the other thing that I remember from that is that we had two investors who had very large separately managed accounts, and they had very liquidity terms that were very generous. They could effectively pull their money when they wanted to. And so every month we would report to them how they had done, and they would decide. And it really those terms really shortened the time horizon, right? And it wasn't necessarily explicitly stated, but I knew that, like, effectively we had 80 or 90% of the assets that were on a very kind of short leash. And I couldn't go in I didn't feel like I could go in with like a 5-year idea, right? Like, so my investment time horizon, because of the terms and incentives, became much shorter, right? And so as a consequence for Greenhaven Road, right, we have a 3-year lockup, mm-hmm. right? And so I can, pursue ideas that have multi-year time horizons. And I'm not, my biggest question is like when we had super short time horizon, you got into things like, well, when are they reporting earnings, and what is the consensus? And like, that's not a game I want to play, right? Like I saw, like, I wasn't good at it. I didn't know how to get an advantage. And so, like, in many ways, Greenhaven Road is set up as a reaction to that, right? So we have a really broad base of investors, right? We have, real lockups on it, philosophical alignment, et cetera. And so both those things left a mark, like the terms and also how the rules change. I won't forget.
Gotcha. All right. So then, we're getting close to wrapping up here because I know you're busy and you got to go. So, second to last question, what advice do you have for new investors in the stock market?
Yeah, it's a good question. Few pieces. I would say don't do it unless you love it. Like, the world doesn't need another investor or fund manager. And if you don't love it, there's probably someone who's great at it. And even after you pay them a fee or whatever, they'll have a better return, and you'll get to go do something you enjoy. So, like, if you don't love it, like, don't do it. is what I would say. There's sort of other ways to make money and live life. I'd say only risk money you can afford to lose. Like using leverage and if you have family commitments and other things, like just leave it aside. And then but so if you love it and you have the kind of money you can afford to lose, I have two things I would say. One is be concentrated and long term, right? That doesn't mean like one stock, but it also doesn't mean own 50, right? Like it's really, really hard to have superior performance if you own 50 or 100 things. You're basically recreating an index. And I think I may have heard this on your podcast from someone wiser than I, but it was you can't borrow somebody else's conviction. I think one of your guests said, and knowing that it's so-and-so's largest position is like not an investment thesis, right? Like ultimately you have to do the work and get comfortable with it and understand it inside and out, I think, if you're going to do it. And so that would be my other piece. You got to do the work.
Got to do the work. That's for sure. So with that, where can my audience go and find more information about your work and you and Greenhaven Road online and also on social media?
Yeah. So we have a website, Greenhaven Road Capital, greenhavenroad.com. There's an investor letter section there that's got, I think 4 or 5 years of old letters, and there's a lot in there to the extent you care. And then you can also sign up for just to get our letters as they come out. There's a form on the website. As I said, we're not going to follow up with you. We're not going to harass you. You can say, hey, I just want the letters. You don't even need them. We won't even send you information about the fund. You're just kind of going to mailing list. Or if you want information about the fund, we'll send you that too if you want it. But so that's on greenhavenroad.com. And then on Twitter, I don't really tweet, to be honest with you. So I'm kind of like a once a month tweeter. I consume a lot, but I don't tweet a lot. But Greenhaven Road, I think, is our handle.
Good. Well, you're about to get tagged on this, that's for sure. So I expect at least one retweet, But but Scott, with that, man, I really appreciate you coming on and sharing your insights, and I really enjoyed our conversation today. Thank you.
All right, best podcast I've ever done.
All right, and the only one as of now. Take care.
All right, thanks. Bye.
Bye.